I tweeted in February, hey, anyone notice that we've just entered a recession? And I got dunked on by all the professional economists and, all these people. But
the experts?
The experts. Yes, exactly.
Correct.
And now it's like the data just came out, negative 1.5% economic growth in Q1. So what I wrote at the time was exactly right. And, I don't know how the Fed threads this needle. I mean, we've got a slowing economy with negative GDP growth. You've got inflation is still rampant. It's not as, I don't think it's going to be as high as last year just because we're lapping a much bigger number from last year. So on a year over year basis, the comps are you start at a higher price level, but inflation's still there. So, I don't know what you do about that. It's a really tough situation.
In a new episode of the All In podcast, industry veterans and Bestai's Chamath Palihapitiya, Jason Calacanis, David Sachs, and David Friedberg cover all things economics and shares their views on the current financial crisis and the recent report from the Bureau of Economic Analysis. The U.S. economy unexpectedly declined 1.4% in the first quarter, according to fresh data on Thursday from the Bureau of Economic Analysis, compared to expectations of a 1.0% increase. Growth was pressured by inventory investment, exports, federal government spending, and state and local government spending. Consumer spending increased. The decrease in real GDP reflected decreases in private inventory investment, exports, federal government spending, and state and local government spending, while imports, which are a subtraction in the calculation of GDP, increased, the report said. Personal consumption expenditures, non-residential fixed investment, and residential fixed investment increased. Both the World Bank and the International Monetary Fund have recently reduced their estimates of the global economy's growth in 2022, with the IMF cutting its projections from 4.4% to 3.6%. The reason? Russia's invasion of Ukraine. While the U.S. is viewed as more resilient to the effects of the war on global supply chains and energy prices, it is expected to suffer from the Federal Reserve's cycle of interest rate hikes that began in March. It's tempting to say the U.S. is inching toward a recession, or it's already in one. At least that's the takeaway some economists had from Thursday's GDP report, which showed that the U.S. economy shrank at a seasonally adjusted annual rate of 1.4% in the first quarter of 2022. This reading comes as inflation is at a 40-year high, forcing Americans to cut back on spending to stay afloat. Yet unemployment is remarkably low. A steep pullback in exports resulting from supply chain bottlenecks had the most significant contribution to GDP last quarter. Welcome back to Savvy Finance. We want to use this opportunity again to thank all our viewers and subscribers. Thank you very much for watching our videos. Let's now go back and listen to the Chamath.
We had negative GDP in Q1 for a whole host of reasons that can effectively be summarized by the fact that we are still trying to restart an economy at the tail end of a pandemic, and we're doing it in fits and starts. And so we have these small bursts of incredible GDP, which we had last year, and then contractions in the economy.
Right.
The thing that's always been true about the United States is that we are a consumer-driven economic engine, which means that as long as people feel confident and they're buying things, the economy tends to do well and we tend to move forward as a society. When consumer confidence ebbs and people contract their spending, we are in a world of hurt. The last couple of years, we've had a lot of consumer savings, right? We've had a lot of money that's been pent up in the system, whether it's stimulus checks or loan forgiveness, or all of this stuff has allowed people to feel much richer. And as a result, they've started to spend in dribs and drabs. The problem now is that because prices are so high, all of those savings have largely been depleted. I just sent you guys a text in the group chat of what consumer spending looks like, and consumer savings rather. And it tells a really, really scary story, which is that the savings boom is largely over. Personal savings rate fell to 6.2% in March, the lowest since 2013. And so what does that mean? Well, it means that the setup is there for us to sort of really contract what we are able to spend as a society. So I think now the odds even push further in this direction, that we could have more quarters of negative GDP. And all of a sudden, we're back to what we talked about before, which is a 2019-like scenario, where the government, or the Fed specifically, races forward to tackle inflation. And in 2018 and 19, it turned out to be a head fake. And by the way, in 2019, the stock market ended up more than 30%, up 32% or something like that. Crazy numbers. Here, and by the way, back then in 2019, China turned over. It looked like it was going to be a fast-moving economic recovery for China, and instead they sort of slowed down. We have the same thing here. We have a quarter of negative GDP. We have China in lockdowns. We have every company that's in the manufacturing supply chain ecosystem telling the world that we don't really know what this is going to look like. Intel today actually said there's going to be shortages in chips through 2024. So I think it could be a very difficult path ahead for the Fed. How do you raise rates 400 basis points into a slowing economy? You could raise basis points 75, 75 bips, maybe 100 bips, but it gives them very little freedom to operate without really tanking the economy.
There's also another point to highlight here, which is in some of this data that was released, there was a strong indication that there are real issues right now with inventories. I don't know if you guys have tried to buy an appliance or a car lately, or a piece of furniture, but like
I tried in the Q4 to buy a car and it was absurd.
I mean, right now there's like 1 year delays to get a friggin' couch. I mean, like everything in the global supply chain, somewhat related to the kind of big inflationary pressure that hit us at the end of last year, and then everyone placed orders. All the factories kind of had to produce a lot. They all couldn't keep up, through to what's going on in China right now, where there's lockdowns and factories are shut down. I have several businesses in the hardware space that are actively searching and frantically trying to find components, suppliers, specific parts, even basic raw materials like aluminum are very hard to get a hold of. And so there's also a very challenging inventory and supply chain problem. When that happens, I can't actually wire money and buy aluminum because I'm waiting for aluminum to show up. I can't wire and buy the microchips I want. I can't wire money to my car dealership and buy money. So that doesn't get credited on the GDP counter because those sales didn't close that quarter. And as we saw with Amazon recently and others, and Apple just said that they're expecting, I think, close to a $10 billion hit this quarter because of supply chain issues. A lot of folks want to spend. The spending interest is there. The capital flows are there. It's just that the supply chain is clogged up and we're so dependent on getting atoms and molecules moved around, and they're all kind of held up in different places, that folks simply can't get their purchases in. And so the revenue triggers don't get hit. And so the numbers don't look good from a growth perspective, but it doesn't necessarily mean that the demand isn't there. This is a significant inventory problem and supply chain problem that's driving a lot of this this adversity right now in the market, it seems.
And interestingly,
and by the way, that doesn't mean that we're not going to have a recession, because when I'm not able to spend money on Apple's spending less on their suppliers and they're spending less on their suppliers. So there is a trickling effect of capital flows, and the recessionary effect may be hit. But there is capital and there is demand for consumption. It's just that we're really clogged up right now.
According to Jason Calacanis, the Consumer Confidence Index has been on a bit of a roller coaster. Even before the pandemic, for the year of the pandemic, we were down in the high 80s, 87, 88, 89. We rocketed back up, in 2021. People started to feel like, oh, we've got these vaccines. Things are going to go back to normal, rocket back up to 128. And it's been a slow tick down to where we're now at 107. And so I think consumers don't know what to think. They don't know if inflation is transitory. They don't know if gas is going to be $7 or $4. They don't know if they should spend on a big vacation or not. And so, in terms of people's planning, it's difficult for people to plan right now. The U.S. consumer confidence fell slightly in April after a modest increase in March, said Lyn Franco, Senior Director of Economic Indicators at the Conference Board. The present situation index declined but remains quite high, suggesting the economy continued to expand in early Q2. Expectations, while still weak, did not deteriorate further amid high prices, especially at the gas pump and the war in Ukraine. Vacation intentions cooled, but intentions to buy big-ticket items like automobiles and many appliances rose somewhat. Still, purchasing intentions are down overall from recent levels as interest rates have begun rising. Meanwhile, concerns about inflation retreated from an all-time high in March but remained elevated. Looking ahead, inflation and the war in Ukraine will continue to pose downside risks to confidence and may further curb consumer spending this year.
The Consumer Confidence Index has been on a bit of a roller coaster. We were at 130 before the pandemic. For the year of the pandemic, we were down in the high 80s, 87, 88, 89. We rocketed back up. In 2021, people started to feel like, oh, we've got these vaccines. Things are going to go back to normal, rocket back up to 128. And it's been a slow tick down to where we're now at 107. And so I think consumers don't know what to think. They don't know if inflation is transitory. They don't know if gas is going to be $7 or $4. They don't know if they should spend on a big vacation or not. And so this, I think, in terms of people's planning, I don't know if people can plan how their own personal budgets, right? And I think that's on the confidence thing, to Chamath's point. We need to have a predictable economy, and it can't be this schizophrenic, to use a term. Sachs, what do you think about what we're seeing here in terms of we're obviously either in a recession or dancing around it. We're basically, on the edge of the cliff right now, I think is probably the most accurate.
I tweeted in February, hey, anyone notice that we've just entered a recession? And I got dunked on by all the professional economists and, all these people. But
the experts?
The experts.
Yes,
exactly.
Correct.
And now it's like the data just came out, negative 1.5% economic growth in Q1. So what I wrote at the time was exactly right. And, I don't know how the Fed threads this needle. I mean, we've got a slowing economy with negative GDP growth. You've got inflation is still rampant. It's not I don't think it's going to be as high as last year just because we're lapping a much bigger number from last year. So on a year over year basis, the comps are you start at a higher price level, but inflation's still there. So, I don't know what you do about that. It's a really tough situation. And when you have this kind of wealth destruction in the stock market, I mean, and there was a good tweet that Chamath, you shared. We should put it up on the screen. I mean, so much like wealth has been destroyed. You don't necessarily see it if you just look at the big cap indices, but you look at all the engines of sort of growth and prosperity, the small caps, the recent IPOs, the growth stocks, they've been absolutely hammered. It really hasn't been this bad since the dot-com crash of 2000, and not just the April period, but all the way in October where it kept going. And then the 2008
recession.
The 2008 real estate crash. So we're already top 3 worst situations for growth stocks in the last 20 years. And when you have that kind of wealth destruction, it eventually trickles down into the economy because people just feel, companies start cutting budgets, people have less money, the spending goes down.
That dynamic that we're referring to in this tweet, in that image, is called dispersion, which means people may be confused when you hear why are all these stocks down so much, but the indices are not down as much. And it's exactly for the reason that David just said, which is that underneath the surface, the mega cap techs consume so much of the market cap of these indices. So, the Googles,
Apple,
the Microsofts, the Apples, and the Teslas. Those 4 just clog up an enormous percentage. I think it's approaching 40% of these indices. And so underneath the surface, you have dispersion, which means you have these tale of 2 kinds of stocks. You have these 4 big mega caps, and then you have everybody else. And the mega caps are generating so much cash that they're just basically keeping the market afloat. So at this point, maybe there's a small silver lining. And that silver lining is that to be bearish right now is effectively not being bearish these growth stocks, because as we said, they've been just decimated. At this point, to be bearish the indices means very specifically to be bearish those 4 names and only those 4 names. And so that may actually mean that the market has effectively crashed already.
The biggest risk facing investors is a Fed that over-tightens in order to quash demand to such an extent that it offsets supply chain inflation for which policymakers have no control over. It is unfortunate that this GDP rate did not meet expectations, but unsurprising as the U.S. economy remains very volatile with geopolitical turbulence from the war in Ukraine, a global supply chain crisis, increasing inflation, and the ongoing COVID-19 pandemic, said Steve Rick, chief economist for Kuna Mutual Group. All of these factors have shrunk GDP growth rates around the globe. On May 26, the government will release an updated first-quarter GDP estimate based on more complete data. This shock drop in GDP is a wake-up call that the economy isn't as strong as we all thought. Chris Zackerley, chief investment officer for Independent Advisor Alliance, said last week, "It's possible that GDP gets revised higher next month, as this is just the first release and there will be 2 revisions, but it is a warning sign. We urge all our viewers to get prepared for a possible tougher times ahead. We believe the economy is going to get worse before it gets better," Thanks for watching, and please stay savvy.